Fears of a US recession have sent all major stock markets tumbling after US jobs market data came in a whole lot lower than expected for the month of July. The FTSE 100 suffered its worst drop in more than a year, and Japan's Nikkei 225 share index was down more than 12% at the close on Monday, its biggest fall since Black Monday way back in 1987. So this begs the all-important question: has the Federal Reserve left it too late to begin cutting interest rates? Hello, I'm Jeremy Maggs. This is No Ordinary Wednesday. Investec's in-depth look at what's driving markets, shaping the economy and changing the game. And joining us today is a regular guest, Investec Chief Economist Annabel Bishop. Annabel, welcome back to No Ordinary Wednesday. Annabel, what's behind this global rout in stock markets?
Yes, hi Jeremy. I think there are a number of factors behind it, but what's really kicked it off was the weaker than expected labour market data that came out in the United States on Friday afternoon. And of course, as we know, South Africa's domestic currency, our rand, is very beholden to what happens in the United States. In fact, overall, global financial markets have a very strong connection. So if we obviously are at risk, perhaps, of the United States not seeing a soft landing, and of course that's what's been factored into markets, then you do have this negative reaction. It's come right through in terms of all the risk assets, whether it's the emerging market currencies, the rand, of course, being one of them, emerging market portfolio flows, and of course equity markets around the world. That's really underpinned this rout in the stock market. Of course, we do find ourselves in a situation where if data comes in that's better than expected as we move forwards, markets might pull back on their views. But of course, we're finding now that the financial markets have really doubled down in terms of interest rate cut expectations in the United States. Previously, there was a factored in only 25 basis points for the September FOMC meeting. That's now been dropped to a 50 basis point cut. That's quite substantial, for the start of the interest rate cutting cycle in the US, followed swiftly by market expectations for a further 50 basis point cut in November. And then, of course, also as well, expectations for cuts, although only at 25 basis points each, but nevertheless for the remaining two FOMC meetings. And of course, those obviously would be the December and of course the January FOMC meeting. So a full 1% cut all in all factored in, whereas previously it was around half that. And of course that then speaks to financial markets and financial market players that obviously this is a grave concern. And while cuts in the United States interest rates tend to be positive for the rand, not if they're coming because there's a risk of a recession. That tends to have a negative effect on the domestic currency.
Do you lend any weight to talk that there might be an emergency interest rate cut in response to this turmoil that you've referred to?
I think we couldn't rule it out. And I think particularly given the fact that, markets are really implying perhaps the US should have cut its interest rate already in July. And that's been a missed opportunity. So obviously doing an intermeeting cut, if we were to get one, perhaps, the remainder of this week of a 25 basis point cut, it would certainly help to calm some of the concern around this area, but in itself would do little to actually repair the damage if, of course, we obviously do see a significant pressed labour market and, of course, other indicators coming out as well. The worries, of course, are that if the United States does not see a soft landing but goes into recession, then, of course, the monetary authorities in the United States would have left the interest rate cut cycle too late.
And Annabel, what impact is all of this having on the rand?
So the rand has obviously suffered, being both an emerging market currency and, of course, a commodity currency. And if you do go into a recession in the United States, that obviously has implications for global economic growth as well as the demand for commodities. So all of these factors tend to weaken the rand. Of course, we obviously have seen the scare coming through already in substantial rand weakness of the fact that the United States may not see a soft landing. It may actually be at risk of recession. Now, for the US to actually have a recession, that's quite a big, requirement. It's not just 2 quarters of contraction. It actually needs to be looked at by their statistical agencies to determine if it's actually severe enough to really be classified as a recession. We actually have had some instances previously where the US economy has had a couple of quarters of contraction, but it wasn't classified as a recession. In other words, it wasn't a severe enough economic downturn. So I think what we are seeing here is jitters coming through from financial markets that the United States monetary authorities could allay by cutting, whether it's an intermeeting cut or by doing a bigger cut in September. That's certainly what markets are looking forward to now, but it doesn't necessarily mean that the US economy is going to go into a collapse. However, the risk has risen. And of course, this really talks to the fact that there certainly has been, quite a lot of concern that the US might have left its interest rate cuts too late. That also comes through as well in a lot of communication from the central bank itself in the United States, indicating that, yes, that is one of the risks to its view of having maintained a restrictive policy so long, that of course there could be a downside effect on economic activity.
Annabel, you've also got a new inflation outlook note.
Yes, we really are not changing our inflation outlook from our side, but rather having a look and doing an analysis of the South African Reserve Bank's change in their inflation outlook. Very important for South Africa. We obviously see our South African Reserve Bank both making its own inflation forecast and then, of course, determining whether or not it would change its interest rate decision based on those inflation forecasts. So what's happened of significance is that we've seen a drop down in the expectations of inflation for this year and next, the inflation rate regaining the midpoint of the target range, the 4.5% point, much quicker than previously expected, allowing South Africa potentially to see its first interest rate cut in September. And of course, with the US previously expected to see a cut in the second half of September of only 25 basis points, in South Africa similar, the rand actually saw a bit of weakness when these inflation forecasts were released from the Reserve Bank, because the expectation really there was that the differential between South Africa and US interest rates would not widen. Now, of course, if the Federal Reserve Bank does move into an emergency meeting and the US cuts its interest rates perhaps this week by a 25 basis point, making up perhaps for not cutting in July, then the rand could see some relief. We could see a bit of strength on the rand. But really what's very important is that South Africa Reserve Bank bringing down its forecast this year for the third quarter to very close to the midpoint and, of course, in line, much more in line with our inflation forecast, has obviously been very helpful for our interest rate view, which is, of course, one of South Africa beginning its interest rate cut cycle in September. Now, of course, if we were in a negative situation and, of course, the global economy, global financial markets, the United States does see great weakness before then obviously South Africa may also look to cut interest rates quicker. But at the moment, that seems unlikely. The focus very much is on the US at the moment.
And Annabel, a GDP outlook?
So we really are seeing from a GDP perspective this year that while the economic consensus is for GDP growth of 1%, and we had similar as well, the risk of the second quarter actually coming out weaker now is obviously of concern. The second quarter of this year, the data will be published early in September, and obviously a weak outcome for the quarter means that from a year-on-year perspective, it might obviously push up GDP growth somewhat from a statistical base effect for 2025, but obviously weaken economic growth this year from 1% to possibly 0.8%, maybe even a little bit worse if that second quarter came through very badly. One might ask, why is the second quarter performing so poorly when we have an absence of load shedding? But of course, we do know that there are still problems in terms of exporting goods from South Africa, bulk commodities. We've heard from mining houses that they have been stockpiling production. There have been some negative monthly data statistics coming out from the minerals resources. Then, of course, manufacturing not doing so well either. All of these have really pointed to the potential for a weaker second quarter than expected. So that's where we're sitting with our GDP forecast. Overall, though, we're looking for a bigger upside given the government of national unity and the successful national elections and formation of government, and that really has given us expectations that will move towards the 3% mark over the next 5 years. But of course, at the moment, there are big infrastructure barriers to quicker economic growth, not just in the ports and railway sectors, but of course also in water provision as well. We obviously are looking for interest rate cuts, as I mentioned, this year. And of course, the fourth quarter of this year, seeing inflation around about 4.5% from the Reserve Bank. And of course, over the course of next year as well, if not a touch lower, does really strengthen the fact that South Africa is expected to enter its interest rate cut cycle in the third quarter of this year, which of course is supportive for confidence and will of course also provide some support to economic growth later in the period, but of course not in the first and second quarters, which have obviously seen those figures already done.
We'll continue this conversation in just a moment, but if you haven't yet listened to Everything Counts on Investec Focus Radio, you are missing out on a series of insightful discussions about personal finance, financial wellness, and building your future wealth. Tune in next Tuesday for episode 6 on navigating money in a relationship. No doubt one of the biggest sticking points for many couples. Right now, though, continuing, Annabel, with our conversation, there's more positive news for consumers. Annual real household finance income increasing for the third month in a row. What's driving that?
So we've really found that real income growth for consumers in South Africa, and that's of course adjusting for inflation, has risen by 1.8% year on year, and that's for the second quarter of this year. Second quarter data is out for real incomes, just not yet for GDP growth. We obviously have had a look at that from a year-on-year basis. However, if you actually have a look at it from a quarter-on-quarter basis, then we actually do see a drop, 2.9%. So real incomes actually fell in the second quarter compared to the first quarter. The second quarter also saw consumer confidence lift to -12 instead of -15 reading. But of course, you'll note that is still in depressed territory. So slightly less depressed for consumer confidence, but consumer confidence, as the BER said, still remain negative. And that, of course, is also a factor as well, which will create that weak quarter. But of course, for consumers looking forwards, the interest rate cut is obviously a very positive outcome when it does come through as expected in September, if not even earlier now. And that would really feed into the situation where we do, of course, then see some support coming through first on the confidence front. And as South Africa moves through its interest rate cut cycle for the remainder of this year and over 2025, it will provide more relief for consumers as well.
I want to move now, Annabel, to the two-pot retirement system. September marks the launch. South Africans being able to access a portion of their retirement savings earlier. But so much commentary saying that it's risky for a country that already has one of the lowest saving rates in the world. What is your specific view?
I think if we move back to what is the intention around this release of monies under the two-pot system, it's really to provide financial support to individuals who may have gone through economic hardship, who are going through economic hardship, or who may be facing it, and of course looking to take some money out of their retirement savings to provide them a bridging. So it could be used to reduce debt or of course cover living expenses. And that's really the intention behind government's release of these monies, which as we know are expected to come through towards the end of the year, the fourth quarter and first quarter of next year. Of course, this might add about 50 billion to consumer incomes if fully utilised. Of course, would be taxed in a similar fashion. But of course, the bottom line really is, will consumers use it appropriately to either reduce debt or, of course, if perhaps an individual has been retrenched, to cover living expenses? Or, is it going to fuel disposable incomes and consumption? And of course, from that perspective, Jeremy, that's obviously where concern comes through that it might not be utilised responsibly.
So what's your view on that? Do you think we're likely to see a big uptick in consumer spending, or do you think that people will be a little bit more judicious?
If we do see 50 billion released, and of course, Jeremy, we don't know the exact figure because it will depend on the calculation of what retirement funds are had at the date when, obviously we look to start moving into this facility to allow the release of monies under the two-pot system. So it might be around 60 billion, perhaps. If you look at household consumption expenditure, that's sitting at about 1.2 trillion. So it's quite a lot less now compared to the actual amount of money that's already being spent each quarter. So it obviously is a concern because the 50 billion is not much in comparison to the overall amount of money that's being spent every quarter. So that would then really indicate that you wouldn't expect to get a massive jump up in household consumption expenditure. But of course, if you're moving into a quarter where there already are a few interest rate cuts under the belt, perhaps one in September, one in November, if obviously we haven't seen anything earlier, then we would find ourselves experiencing a double boost to household consumption expenditure, both lower interest rates and, of course, monies flowing through from the two-pot retirement system release. And that, of course, then could provide a small amount of additional growth. But, of course, we've had some quarters where you've seen significant contractions as well, and that could obviously counterbalance it. So, yes, we think will have a positive effect on the HCE, household consumption expenditure, and therefore on GDP growth, but we must just be aware a small amount of money being released in the overall context of how much is spent every quarter and annually.
Annabel, let's pivot and let me widen the scope. We've been speaking about a lot of positive sentiment from foreign investors. Is this translating into them buying local bonds and equities?
So after the successful completion of the elections and the establishment of the government of national unity, really taking us towards the end of July with the executive formed in government as well, the ministers. All of that really has obviously had a very positive effect. And we actually saw the yield drop towards around the 10.5 mark, perhaps, closer to 10.60. But let's bear in mind that it was actually above 12% in April. The yield was about 12.23. This investor positivity has obviously risen very substantially towards South Africa, as reflected in our bond market. And it is really an indication that foreigners did come in then at that period and obviously were significant buyers. The recent rout in the stock market in early August obviously would have caused selling. And that obviously would have been the reason why we saw substantial rand weakness, a general deleveraging in terms of portfolio assets of emerging markets. But if we go back to the positive side of the story, really, coming through the elections so well, many countries seeing elections this year not so well. So investors have rewarded South Africa. And of course, the sharp moderation in South Africa's monetary policy inflation forecast that we talked about earlier also has added to some positive sentiment for the bond market as well. So all of these factors, are supportive. We do obviously have a good year and a good few years ahead. Expectations are running high, and the government of national unity not only will last, but prove highly successful as well. And of course, that really has seen the political risk faced before the election moving substantially out of the system. So all of these factors, do really culminate in a positive situation. But let's, of course, not forget that financial markets can be very volatile. The rand is a volatile currency. And of course, we've seen that by the activity at the start of the month. So just as foreigners can pile in terms of buying South African bonds and, of course, equities, so too they can move very quickly out if they do perceive perhaps a risk of recession in the United States or some other factors which make them deleverage.
So let me ask you this. You reference this good national mood. We have spoken in the past about the private sector sitting on this cash mountain. Is there a propensity now, do you think, to invest?
So I think if we have a look at fixed investment in South Africa, over 70% of fixed investment is actually fulfilled by private sector investments. So the private sector already makes the bulk of investment in South Africa. I think there's a misnomer to think the private sector is sitting on a big cash pile and not investing. Instead, that money is actually kept for use in terms of depreciation of assets to replace assets. And it's not actually an unusual amount of money. Yes, the fact that bond yields have been very high, we referenced how they were over 12% in April already, versus the fact that in the 2000s, the bond yield in South Africa actually dropped to 6%, does provide a strong attraction for savings in South Africa to go into that high yield. That actually, of course, also takes away from the desire to invest in an economy which is very weak. But the answer to you, Jeremy, is yes. I think we will see an improvement in fixed investment in South Africa. Of course, from a foreign investment perspective, given that overall savings actually are quite low compared to many other countries, South Africa would need to attract foreign investment as well. And of course, there foreigners will look quite closely at factors like, do we have consistent capacities to supply running water? We know that we've had a remarkable success in terms of electricity, but we are still seeing problems in terms of transport and, of course, as well, the railway system, the port system. All of those factors do provide some concerns. So yes, we are looking for an improvement in economic activity, an upturn in economic growth. We think that at the end of a 5-year period, South Africa will see economic growth of around 5%, if not quicker. But of course, much depends on how quickly we see government move to repair its infrastructure issues that are really holding up the system. Government and the parastatals only invest about 15% of total infrastructure each in the economy. And that really talks to the fact of why we are in such a difficult situation with many of these factors of production in South Africa.
So, Annabel, let's close the circle on this conversation and a quick look at the gold market.
Yes, gold's so important for South Africa. It really has a good beneficial effect in terms of our export revenue. Not a bulk commodity, so you can export quite a bit of gold and get a lot of revenue in without taking much space in terms of our really weak export infrastructure. But of course, having a look at gold markets themselves, well, of course, gold jumps when there's worries about the ability of financial markets to obviously perform as expected. And of course, the recent rout in equity markets did obviously create some concern there, seeing a move into safe haven assets, which obviously would have strengthened the gold price. But also, of course, as well, we saw some concerns over China's growth, and that, of course, also aided the gold price. As we look forwards, the gold price also very heavily influenced by global inflation, and, of course, inflation being slow to descend, particularly around the world, but also in the United States. So that really has been one of the reasons why the US has maintained its restrictive monetary policy, but that obviously does place us in a situation now where there are worries going forwards in terms of, does the United States need to cut its interest rates quicker than expected? And of course, if that's a situation and we do see a quicker rebound, that'll also have an influence. So yes, it has been positive for South Africa that we have seen the gold price perform so well. But of course, what we really need in South Africa is strong infrastructure investment from the government. And of course, they are looking at private sector partnerships, but it needs to obviously be on attractive terms to really manage to lift the growth potential for the economy.
Annabel Bishop, Investec Chief Economist, as always, thank you so much. Please join us again in 2 weeks as we continue to explore money trends shaping your world. If you haven't yet added us to your podcast feed, simply search for Investec Focus Radio SA wherever you get your podcasts and hit that subscribe button. Until next time, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.